Insights.
This is Akashvani. In the program Insights, now we bring a discussion on RBI's policy decisions and the outlook for the Indian economy. The participants are A.K. Bhattacharya, economic analyst, and Arjun J. Chaudhary, anchor.
I'm joined by Shri A.K. Bhattacharya, economic analyst, and today's topic of discussion is on the central bank, RBI's policy decisions and the outlook for the Indian economy. AKB, as we fondly call him, good to have you on the program.
Thank you, Arjun, for having me here.
AKB, the repo rate has been left unchanged at 5.25% by the Monetary Policy Committee. They had a 3-day meeting under the RBI Governor Sanjay Malhotra. The meeting decided on leaving the repo rate unchanged at 5.25%. It was a neutral stance unanimously. What were the key reasons why the central bank took this decision?
Well, this decision was widely expected that there will be no increase or decrease in the repo rate, which is essentially the cost of money for the banks and the banking system. Now, the key reason why the RBI's Monetary Policy Committee decided to stay put at 5.25% and also maintain the neutral stance was that it decided to look through the broad uncertainties and the price pressures or the growth challenges that the economy may face in the coming few months. Its own assessment was very, very important here. Its own assessment was that inflation rate for the full financial year in 26-27 should be around 5% for the full year. Now, this was a 10 basis points decline from what it had earlier projected in June policy. Similarly, on the GDP growth assessment, in June policy, it had projected an economic growth rate for the Indian economy at 6.6% for financial year 2026-27, but now it has raised it a bit to 6.7%. As you know that we are going through the challenges of facing up to an adverse weather situation, which may impact agricultural output. It may also affect rural economies' demand. At the same time, there is the geopolitical tensions. The West Asia crisis is not yet over, uncertain. Crude oil prices are going up and down. So it seems to me that the RBI has decided to stay put and look through this fluctuating environment and decided to bank on its own assessment that inflation rate will, after all, be lower than what it was earlier estimated, and in any case, lower than the upper tolerance band of 6%, which is 5%, and growth will be higher than what it had earlier estimated, and it will be at 6.7%. Given this aspect in mind, it decided to stay put, and probably there may not be any further rate hike or rate hike speculation for the next couple of monetary policy reviews, which take place every 2 months.
AKB, typically the repo rate is the rate at which the commercial banks borrow from the central bank and then they relend it to the retail borrowers. To what extent do you see the bank rate being affected as a result of the repo rate remaining unchanged? Because banks also looking at their own net interest income. Do you see those margins improving? And do you see the customers reeling as a result, or do you see the banks also keeping the bank rate unchanged?
I don't see any immediate change in the bank rate, the rate at which the banks are relending their resources of their various clients. I don't see any immediate impact. Even in the housing sector, I don't see any impact either way. And housing sector is the one sector which would have been impacted. But in the housing sector, there was this apprehension that the repo rate might go up. Now, if the repo rate had gone up, then the housing sector would have been immediately been impacted because they are the spread, and the follow-through impact for the housing sector loans is very, very quick and sharp. But in the case of the corporate sector, the corporate credit, the banking sector, I don't see any impact on either their margins or on their rate which they lend money to their clients.
So the repo rate is at 5.25%. That's remaining unchanged. You have the bank rate also unchanged at 5.5%. The SDF, the standing deposit facility, is at 5%. The marginal standing facility is also at 5%. What are these two rates and why is this equally important?
Well, they are important in the sense that they allow the RBI and the bank to monitor the flow of resources and also provide a kind of a supplementary support to the banking system. In a sense that if the repo rate is giving you an overall broad indication of at what level and what should be the level at which the banks can lend their resources at what rate. The margining standing facility and these facilities are essentially providing kind of a support system which would have changed if the repo rate would have gone up. They would have gone up. Instead of 5%, the bank rate would have gone up or similarly. So they are always in sync with the bank rate, both the marginal standing facility as well as the bank rate.
So now we know what the rate of borrowing is for the banks from the central bank. What about the reverse repo rate, where the central bank actually borrows from the commercial banks at 3.35%? How do you see that impacting deposits?
Well, that has also not changed, and the reverse repo rate is normally used to suck out liquidity in a sense that if the banking system is flush with liquidity, then the reverse repo rate is used as an instrument and makes a little more attractive. So here also the reverse repo rate and the repo rate, the gap has remained the same. So essentially in the entire instrument, the credit interest rate system, and nothing has changed. What has changed is the RBI Monetary Policy Committee's assessment of how the economy will fare and what kind of pressure the economy will face because of inflation. Just on the question of the retail inflation, the RBI's assessment is that actually the retail inflation in the second quarter, which is going to end in September end, should be only at around 4.7%, which is slightly higher than the lower band of the inflation rate target. So the target is 4%. So therefore, the quarter two prognosis is very positive. Whereas in quarter three, which is the October, November, December, the RBI monetary policy feels that the inflation rate may just increase to 5.9%, which is almost close touching the upper tolerance band of 6%. But then in the fourth quarter, which is the last quarter, January, February, March of 2027, it is expected to come down to 5.5%. So therefore, the overall estimate is that the inflation rate will be 5% compared to the earlier estimate of 5.1% is, of course, will be higher than what was the inflation rate in the last year, which is 2025-26. But the Reserve Bank of India monetary policy members are of the view that given the growth trajectory of the economy recording a growth rate of 6.7% for the current financial year, there is no need for the RBI to step in to cool down the economy a bit by raising the interest rate.
So the headline retail inflation estimate for the financial year is at 5%. You just explained that it's been revised from 5.1% to 5%. So there's a 10 basis point cut. And as a result, the real GDP has also gone up to 6.7% as opposed to 6.6%. Again, 10 basis point rise in what the expectations of GDP growth are, the gross domestic product. And when we talk about real GDP, we're taking into account growth, taking into account inflation as well. So instead of it being nominal, we're looking at real GDP growth. So how does that translate in terms of the growth in the overall economy in terms of sectoral growth?
Well, given the fact that the RBI believes that the inflation is caused mainly through supply side pressures, which means there are fears of supply side disruptions, which are essentially that if the crude oil or the food grain output is not good because of erratic monsoon, the El Nino effect, or the West Asian crisis deteriorates, so therefore the crude oil prices go up. So these are all the supply side pressures that may. So the RBI's assessment is that the inflation rate will remain at 5% for the full year, mainly because of supply side pressure. And it was unwilling to take any decision on a rate hike based on this assessment, that purely because there is no demand side pressure on inflation right now, it is mainly a supply side pressure, which can well be transitory and may be temporary. For example, the rain situation improves in, let us say, in September, end of second half of August and the first half of September. It is possible that the impact on the food economy as well as in the rural economy is less adverse than what was earlier feared. It is possible that the West Asian crisis gets resolved much earlier than it is feared and that it might continue. So in those situations, the supply side pressures will go away and suddenly the inflation outlook will also get better. So therefore, given the fact that it is only the supply side pressure that is causing this inflation to go up, so the Reserve Bank of India's Monetary Policy Committee was of the view that it is probably wiser not to take any decision right now because these are supply side pressure and they may be a temporary pressure. So that is why, and particularly also in light that growth momentum has not yet been impacted adversely. So therefore, let the growth continue at its current momentum. Because remember, if you increase the repo rate, it will have an impact on the growth as well. And also, as I told you, that it will have an impact on the cost of money. The corporates will have to borrow money at a higher rate. The housing sector, which is a big sector, will have to readjust to a higher cost of money for construction activities. So that is why RBI has taken a safe and a sensible policy stance of status quo for the moment and hoping that this inflation crisis, or not challenge, so to say, will be overcome without the need for any increase in the repo rate, at least in the current calendar year.
So the RBI Governor Sanjay Malhotra also spoke about the first quarter corporate results, especially in the manufacturing sector, and he linked it to private consumption and the rise in discretionary spending. How is that equally important when you're looking at gross domestic product growth?
Well, they both play a very important role. The consumption is a very, very important element in India's growth dynamics. Almost 55% of the economy is composed of consumption. So if the consumption impulses are still strong, private spending is going on. Investment engine has been kept going through the government expenditure. And if you look at the government data, the budgetary data for the first 4 months actually, you realize that the government's capex program has maintained a strong momentum. So investment has been kept going through the government. Consumption is going because the private spending is going on, consumption is going on, which is why the RBI governor has come round to the view that probably there is need for a greater clarity to emerge, particularly with regard to inflation path and its composition before he can take any further policy action.
AKB, we spoke about inflation and how supply side pressures, especially oil and food, is likely to come down if the geopolitical uncertainty and risks are managed globally. Core inflation has been deemed to be moderate. Why is that the case?
Well, that's because the core inflation does not include food and fuel. And if you take out food and fuel, the inflation is quite modest. So if you look at traditionally most central bankers' approach to inflation management policies, it is that if you look at the core inflation, which is without food and fuel, because food and fuel are seasonal and they fluctuate at a decent pace. And also they are prone to supply side pressures. So if you take food and fuel out, your core is fairly moderate. If you take out gold and jewelry, the core gets even more moderate. So therefore, the overall approach the RBI Monetary Policy Committee has been that since it is a supply pressure-led inflation outlook, since the core inflation is moderate, and since even the core inflation has a good component of gold and jewelry that has given rise to the core, the RBI Monetary Policy Committee has decided to stay put with the current repo rate.
Well, thank you so much, AKB, for being with us on this program and talking to us in the most simplistic terms what the RBI policy decisions are and the outlook for the Indian economy as per RBI Governor Sanjay Malhotra. Thank you so much, Shri A.K. Bhattacharya, for being with us on this program.
You were listening to a discussion on RBI's policy decisions and the outlook for the Indian economy. The participants were A.K. Bhattacharya, economic analyst, and Arjun J. Chaudhary, anchor. This program was produced and presented by the News Services Division of Akashvani. You can listen to it on our mobile app, News on AIR. This program is also available on our YouTube channel, News on AIR Official. You may share your feedback about this program through email at airnsdtalks@gmail.com or WhatsApp on 9289094044.
Insights.